Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we are looking at CleanSpark.
If you find our talks useful, please consider subscribe, like, and comment underneath. So, I want you to imagine a company that just reported a nearly $400 million loss in a single quarter. Normally, you'd think Wall Street hits the panic button, right?
Oh, absolutely. Investors flee, the financial press writes the obituary, it gets ugly.
Yeah, but we are looking at a company today where the exact opposite is happening. Following this massive eye-watering loss, their stock is up nearly 50% year to date.
Which is just wild to think about.
Right, and analysts are aggressively slapping premium price targets on it. How does that make any sense? Well, I think it comes down to this concept of the business chameleon.
It really is one of the most fascinating phenomena you see in the corporate world. A business chameleon is, a company that sets out to do one very specific thing. They build out all this massive infrastructure to achieve it, and then suddenly
They realize the byproduct is worth more.
Exactly. They realize the raw byproduct of their operation is actually way more valuable than the product they originally intended to sell.
It's like, imagine a lumber mill operating for decades, right?
Yeah.
And then one day they discover that their leftover sawdust is somehow this miracle compound for pharmaceutical companies.
Right. Suddenly you aren't valuing them as a wood provider anymore. You have to value them as a high-tech biotech supplier.
And that brings us to the core of our analysis today. We're unpacking this wild corporate identity crisis currently playing out with CleanSpark. On paper, they are a high-volatility Bitcoin mining company.
But under the hood, they are attempting this massive, potentially super lucrative pivot to become an AI infrastructure giant.
So we need to figure out, for you listening, if this is a legitimate transformation or just, a masterclass in market hype. And before we get into the heavy numbers, navigating these kinds of volatile, shifting narratives requires the right approach to wealth-building context.
Yeah, which is why we have to mention VIP Algos. It's a tool specifically designed to help map out these exact kinds of wild chart setups. Exactly. The link for VIP Algos is below in the description. We'll touch on how traders use it a bit later, but it's essential context when looking at a chart that swings as aggressively as CleanSpark's does.
Because it really is the ultimate test of narrative versus fundamentals right now. When you look at CleanSpark's current reality, their core business mining cryptocurrency is acting as this incredibly heavy anchor on their financials. Yeah, I was looking at their Q2 2026 numbers, the quarter ending March 31st, and the operational reality is pretty grim at first glance. I mean, their revenue missed estimates entirely.
Yeah, it fell 24.9% year over year.
Down to $136.4 million. And then you have that massive $378.3 million net loss. That translates to roughly $1.52 per share.
Which is brutal on paper.
Right. So for anyone just glancing at a standard stock screener, this company looks like it's in a terrifying freefall.
But to understand why Wall Street isn't panicking, you really have to separate the operational health of their data centers from the strict accounting rules governing their balance sheet.
Okay, break that down for us.
So the vast majority of that $378 million loss, like $224.1 million of it specifically, was a non-cash mark-to-market loss.
Because they hold the Bitcoin they mine rather than just selling it immediately to cover their costs.
Right, exactly. They hold this massive treasury of roughly 13,470 Bitcoin. And during this specific quarter, the broader crypto market took a severe hit.
Right. Bitcoin plummeted from, around 100,000 down to about 76,000?
Yeah, a massive drop. And under U.S. accounting rules, when the value of a volatile digital asset drops like that, a company is required to record it as a loss on their income statement, even if they haven't sold a single coin.
Okay, so they didn't actually burn $224 million in hard cash from their bank account just to keep the lights on.
No, not at all. The digital gold sitting in their corporate vault just temporarily lost some of its shine on paper. And if you strip away that paper loss, the structural fundamentals of the business are actually surprisingly robust.
Really? Even with the crypto winter dragging them down?
Yeah, I mean, their gross margins remain over 40%, which is incredibly healthy for any heavy industrial operation. And analysts constantly point to their fortress balance sheet.
Which is a phrase you don't often hear with crypto miners.
Right. Even at lower Bitcoin prices, that treasury is still worth roughly $1 billion. They have $460 million in raw cash, and their working capital is sitting at $1 billion.
And that was bolstered by that recent $1.15 billion convertible debt raise, right?
Exactly. On top of that, management is actively buying back shares. They are reducing the overall share count, while a lot of their competitors in the mining space are, you know, actively diluting their shareholders just to stay afloat.
Okay, so those balance sheet numbers are undeniably massive. But I'm going to push back here for a second.
Go for
Because paper loss only excuses so much, right? I want to look at their actual cash burn, not just the accounting quirks. Their free cash flow in the most recent quarter was roughly negative $173 million.
Yeah, that's a big number.
It is. They are bleeding actual hard cash on massive capital expenditures while riding this entirely unpredictable roller coaster of Bitcoin prices. So why are institutional investors so eager to fund a company bleeding 9 figures a quarter?
That negative free cash flow is actually the key to this entire puzzle. They aren't bleeding cash because they are bad at mining Bitcoin.
Then where is it going?
That money is being aggressively deployed into capital expenditures because they aren't just running a crypto farm. They're building out a massive, self-contained electrical power grid.
Ah, the business chameleon is changing colors.
Exactly. Unlike competitors who rent space in third-party facilities, CleanSpark owns and operates its own data centers. This gives them total control over their physical infrastructure.
Which is huge.
It is. In the crypto world, this allows them to run incredibly efficiently. They are operating at 16.07 joules per terahash, which puts them at the absolute top tier of the industry.
Wait, hold on. Time out. Joules per terahash. For those of you listening who don't run crypto server farms in your spare bedrooms, what does that actually mean?
Fair enough. Let's unpack that. It's basically a measure of computing muscle versus energy cost. They've achieved 50 exahashes per second of operational computing power.
Okay, and exahash is the muscle.
Right. It's how fast their machines can solve the cryptographic puzzles required to mine Bitcoin. 50 exahashes means they have an unbelievable amount of computational power actively running.
Got it. And the joules per terahash.
That measures how much electricity it costs them to flex that muscle. If CleanSpark were, say, a logistics company, the exahash is how many semi-trucks they have on the road, and the joules per terahash is their gas mileage.
Oh, okay. So they are running a massive fleet of trucks that get industry-leading fuel efficiency.
Exactly. But here's where the catalysts really kick in. The computing power isn't what Wall Street cares about right now. It's the energy footprint.
Yeah, I was looking at those numbers, and the math here is wild. They are generating all that computing power, that 50 exahashes, using about 808 megawatts of electricity.
Right.
But their long-term utility contracts give them access to 1.8 gigawatts.
Yes. Which means they are sitting on almost a full gigawatt of unused secured power.
A full gigawatt?
And in the current tech landscape, an undeployed gigawatt is arguably way more valuable than the Bitcoin they are currently mining.
To put that in perspective for everyone, 1 gigawatt is an absolutely staggering amount of electricity. It's enough to power the equivalent of roughly 750,000 homes.
Right. And more importantly, the traditional power grid simply cannot keep up with the demands of the AI revolution.
Right. The tech giants, the Googles, the Microsoft, the Metas, they are just desperate for raw power to run their high-performance computing clusters.
Which brings up a really important reality about the mechanics of this pivot. A lot of people hear CleanSpark is pivoting to AI and assume you just, unplug a Bitcoin machine, plug in a ChatGPT machine, and call it a day.
Yeah, it's definitely not that simple. The physical reality of this transition is incredibly complex, isn't it?
Oh, completely. The physical differences between a Bitcoin mine and an AI data center are night and day. Bitcoin mining uses ASICs application-specific integrated circuits.
Okay.
These are rugged, relatively cheap machines designed to do just one mathematical equation over and over. You can essentially stack them in a giant warehouse with massive industrial fans blowing ambient air across them to keep them cool.
So it's loud, it's hot,
Yeah.
and it's physically pretty unrefined.
Yes, very unrefined. AI, on the other hand, requires massive clusters of highly sensitive, incredibly expensive GPUs.
Graphics processing units.
Right. These servers require specialized clean rooms. They need fiber optic networking with zero latency and advanced liquid cooling systems because they run so hot that traditional air conditioning just can't handle them.
Wow. So CleanSpark essentially has to gut these raw warehouses and rebuild them to a much higher, much more expensive standard.
They do, but here's the secret. The tech giants don't really care about the warehouse. They care about the substation outside the warehouse. Securing land, getting environmental permits, and building the high-voltage transmission lines to pull a gigawatt of power from the utility grid. That takes 5 to 7 years in today's regulatory environment.
And CleanSpark has already done that.
Exactly. The hardest part is already finished.
It's like a real estate developer who bought thousands of acres of cheap, barren desert land decades ago just to build a couple of quirky warehouses. And then suddenly a massive tech boom happens, a new city expands, and that empty, barren land they are sitting on becomes the most sought-after commercial property in the entire country.
Because it's already zoned and wired.
Exactly. The product was Bitcoin. The byproduct was secured electrical capacity.
And if you look at the forward estimates in the research, if CleanSpark successfully retrofits their infrastructure and leases out this undeployed power to AI companies, their revenue could hit $997.6 million by 2029.
Nearly $1 billion in revenue. So we have a company caught between two highly volatile, warring narratives. On one side, you have the icy winds of a crypto winter causing massive paper losses. On the other side, the absolute euphoria of the AI boom, with the gigawatt of power acting as this golden lottery ticket.
And because of this tug-of-war, CleanSpark's stock price is an absolute roller coaster right now. Let's look at the technicals to see how the market is actually pricing this.
Yeah, where's the stock sitting currently?
It's trading around $17.24. Now, that is a massive recovery from its 52-week low of $8.01, but it has retreated significantly from its recent high of $23.61.
So it's bouncing around in the middle.
Exactly. Technical analysts refer to this current price action as a psychological consolidation phase.
Meaning investors are essentially holding their breath. They see the AI potential, but they feel the crypto pain, and the stock is just ping-ponging back and forth while they wait for a clear winner.
Right. The stock is trapped in a very tight range between 1758 and 1885. The data indicates that 1885 is a critical resistance level. Institutional algorithms and retail traders are both watching that specific line.
And if it breaks above that?
A breakout above 1885 could signal massive acceleration. It would essentially confirm that the market is finally pricing in the AI narrative over the Bitcoin reality.
And when you have a stock that swings this wildly, these high beta assets, as they're called, people naturally look for tools to map out the chaos. Which brings us back to VIP Algos.
Yeah, VIP Algos is a perfect factual example of how modern traders attempt to quantify this extreme volatility. It's a TradingView indicator suite used across various asset classes, whether it's stocks, crypto, forex.
Right, and it's engineered to help map out the psychology of the chart. So instead of just staring at a squiggly line and guessing, a suite like VIP Algos uses moving averages and volume profiles to mathematically plot out where buyers historically step in and where sellers historically take control.
Exactly. It provides visual trend alerts, directional overlays, and helps you identify potential support and resistance zones.
Okay, I need to jump in here for a second to advocate for you listening, because whenever we talk about trading tools or visual chart indicators with high-flying, news-driven stocks like CleanSpark, all my alarm bells go off.
Yeah.
Just to be completely clear, a tool like VIP Algos doesn't automate your trading or guarantee you are going to pick the right direction, correct?
Oh, that is a crucial distinction. No, it absolutely does not. VIP Algos is purely an educational chart analysis tool.
Right.
It is not financial advice, it does not manage your portfolio, and it cannot guarantee profits. Trading a high beta stock like CleanSpark carries massive inherent risk.
Right. An indicator tool simply helps you visualize historical data and mathematical probabilities so the chart is easier to read. The actual risk management, the position sizing, and the final decision to enter or exit a trade remain entirely on the trader's shoulders.
You still have to do your own fundamental research. An indicator might show you that 1885 is a heavy resistance level based on past volume, but no algorithm on Earth can predict if a CEO is going to post something controversial online tomorrow.
Or if a regulatory agency is going to announce a new crackdown.
Exactly. Technical analysis maps the footprints of the past and the present. It is never a crystal ball for the future.
So the chart tells us investors are holding their breath, waiting for a catalyst to break them out of this consolidation phase. But charts don't move in a vacuum, right? What are they actually waiting for? Because looking at the sentiment data, it seems like there is a very specific, very loud rumor right now that could act as the match in this powder keg.
Oh, the rumors are where the theoretical AI pivot turns into highly specific corporate espionage. There is an unconfirmed, highly speculative rumor circulating through Wall Street right now that CleanSpark is in advanced talks with Meta.
Mark Zuckerberg's Meta.
Yes. The rumor suggests that Meta is looking to lease a significant portion of CleanSpark's massive 250-megawatt site located in Sandersville, Georgia.
Wow.
And this lease would not be for mining Bitcoin. It would be strictly dedicated to housing Meta's AI and high-performance computing workloads.
Okay, if that rumor becomes a signed contract, it completely validates the entire business chameleon thesis. It instantly proves to the market that CleanSpark isn't just a crypto miner with a theoretical side project, but a legitimate institutional-grade AI infrastructure player capable of serving the biggest tech companies on the planet.
And Wall Street analysts are already leaning heavily into this possibility. They're effectively pricing in the pivot before the ink is even dry.
What are the analysts saying exactly?
The sentiment is overwhelmingly bullish right now. Out of the major analysts tracking the stock, there are between 12 to 16 consensus strong buy ratings, with an average price target hovering around $20.
Okay, that's a solid premium.
Yeah, and the firm Citizens recently initiated coverage with an outperform rating and a very aggressive $27 target. But perhaps the most telling indicator of how Wall Street views this sector is a recent note from the investment firm Bernstein.
What did they say?
They officially dubbed these large-scale Bitcoin miners as the power landlords of AI.
The power landlords. That phrase perfectly encapsulates the real estate dynamic we were talking about earlier. They own the grid connections and big tech has to pay them rent. But as I was digging into the risks and the bear case, I spotted a glaring red flag.
Okay, let's hear the bear case. What did you find?
Well, something that makes me seriously question the timeline of this so-called imminent pivot. If the analysts are so universally bullish, and this massive Meta deal is supposedly in the works, why did we see a wave of Rule 144 insider sales immediately following the Q2 earnings report?
The insider seller.
Right. For those of you who might not know, a Rule 144 filing is basically a mandatory public notice that corporate insiders, executives, board members, people who know the inner workings of the company, are selling their own personal shares of stock. So the obvious question is, are the insiders cashing out at the top while retail investors are left holding the bag on these Meta rumors?
It's a fair question. The optics of insider selling are rarely positive, and it naturally adds a bearish tone to the immediate market sentiment. When the people running the company are selling shares, it forces investors to question their conviction.
Exactly.
However, context is really vital here. Rule 144 sales are often highly structured and pre-planned months, sometimes years in advance.
Right, they set them up on a schedule.
Yeah. Executives use them for tax obligations or standard portfolio diversification. It does not automatically mean the leadership team believes the AI pivot is doomed.
Sure, but it does highlight that management is perfectly willing to take some chips off the table at these current valuations. And that naturally forces us to look closely at the dark side of this thesis. We have to debate the execution risk.
Definitely.
What actually happens if the grand AI pivot fails?
The bear case is substantial, and it really hinges on the dual threat nature of their business model. The primary risk is their ongoing Bitcoin dependency. Despite all the glamorous talk about AI and data centers, CleanSpark is still fundamentally tethered to the cryptocurrency markets.
Right.
If the price of Bitcoin continues to slide, and the data noted a continued heavy sell-off environment around June 2026, those non-cash mark-to-market losses will just keep cratering their headline earnings.
The crypto anchor drags them down before the AI balloon has enough helium to lift them up.
That's a great way to put it. Furthermore, their free cash flow will remain deeply negative because they are still funding the huge capital expenditures required to keep their Bitcoin mining fleet competitive.
Because the difficulty of mining Bitcoin increases over time.
Right, exactly. Meaning they have to constantly buy faster, more efficient ASICs just to maintain their current production levels.
And what about the execution risk on the AI side? We talk about how gutting a warehouse and installing liquid-cooled GPU clusters is incredibly expensive. Wall Street is currently valuing this company based on a $997 million revenue projection for 2029. But that revenue is entirely uncontracted.
That is the core of the execution risk right there. The market is pricing in a future that hasn't been legally inked yet.
It's like a Hollywood movie studio banking its entire financial future on a blockbuster script that hasn't actually cast a lead actor yet.
Yeah.
The script might be amazing. The 1 gigawatt of secured power is undeniable. But if you don't get Brad Pitt, or in this case Meta, to sign on the dotted line, you don't have a movie. If the Meta deal falls through, if negotiations stall, or if they hit unforeseen regulatory hurdles regarding zoning for an AI data center versus a crypto mine. This stock becomes a massive buy the rumors, sell the news trap.
You are paying a premium today for infrastructure that may take years to yield actual contracted cash flow. And during those years, they are entirely at the mercy of Bitcoin's volatility.
So, synthesizing all of this for our final verdict, we have a massive 1 gigawatt power upside weighed heavily against very real uncontracted revenue risks, the technical challenges of retrofitting data centers, and the unrelenting volatility of the crypto market. Where does the research ultimately land on CleanSpark's future?
Taking all the variables into account, the research models assign CleanSpark an 8 out of 10 bullish score.
An 8 out of 10. That is highly constructive, despite the execution risks we just debated.
It is. The final verdict categorizes CleanSpark as a multi-year asset. It is explicitly labeled as a high beta asset, meaning the volatility will be intense.
So it's suited for patient accumulation on weakness, rather than buying aggressively at the top of a rumor cycle.
Exactly. The underlying thesis is that the 1.8 gigawatts of contracted power and the $1 billion Bitcoin treasury provide a robust structural safety floor. Those tangible assets alone justify a significant portion of their current market cap.
The power grid access basically acts as an insurance policy against the crypto volatility.
And if they secure a confirmed AI lease, whether it ends up being with Meta, Google, or another tech giant, that event would act as the ultimate catalyst. It would trigger a massive multiple expansion as the market finally strips away the crypto miner label and fully prices them as an AI infrastructure provider.
So the chameleon just has to survive the crypto winter long enough to reveal its new colors. Which brings me to a final thought I want to leave you with today.
Right.
We've spent this entire time talking about CleanSpark leasing their secured power to the tech giants.
Right.
But if electrical power is truly the ultimate, undeniable bottleneck for the next decade of the AI revolution, how long will it be before companies like Meta, Google, or Microsoft stop negotiating leases and just decide to use their multi-trillion-dollar balance sheets to outright acquire these crypto mining companies just to strip them for their power grids?
It is the billion-dollar question hovering over the entire sector right now. The infrastructure might eventually be too valuable to merely rent.
The ultimate fate of the business chameleon might be getting swallowed whole. Keep questioning the narratives, watch those resistance levels, and remember to check out the VIP Algos link below in the description to help map out these volatile charts. And if you enjoyed our analysis today, please consider subscribe, like, and comment underneath. We'll see you next time.